Hi, Steve Van Metre here, and welcome to your Wednesday night premiere, where we take about 15 minutes every Monday and Wednesday nights to try to make sense of markets that might actually possibly be making a little bit of sense, but we'll see. I'll let you be the judge and jury of that. But what's going on in the markets today? We're going to talk about, our focus today is why gold sells during every market, or going into every recession, and then has a massive rally afterwards. So I know a lot of people are like, oh my God, gold's taking off. This is it. No, not the big one. It's coming soon. But you don't have to take my word. I'll just show you the data and you decide. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. This material is not to be construed as recommendation or solicitation to buy or selling security, financial product, instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in the video that I do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. So let's hit some stuff real quick. The Nasdaq McClellan Summation Index went negative. Remember, when it breaks zero, it starts to indicate that whatever trend the market is going in, it will most likely be pointing down soon. But with no surprise and time allowed, we'll take a look at the charts and see what's going on with there. Okay, so let's chat about gold real quick. Everybody thinks this is a big bullish breakout. It's not. Look, I get it. I understand everyone's like, oh no, it's going. Here's the problem with gold. It's like, if you've ever invested in crude oil, it's like this. And you don't want to be there. You don't want to be buying up here when this happens. You want to buy when you're as sure as possible that you're in the right place at the right time. Because I've seen these gold mine stocks move 5-10% in a day. It's a lot of risk. So you need to make sure what you're doing makes sense. So in order of what we're looking at, because things are getting actually interesting here, and hopefully we'll have time to touch on this, is there are lower risk, high reward trades that we're going to look at, and if time allowed, I'll touch on that. Then you look to your higher risk, high reward trades. That's gold, because again, you can think you're in the right space, and then boom, floor falls out. Don't want to be there. All right, gold follows the money multiplier. We've looked at this before, but let's go take a quick look at it. Now you can't see it very well this in the .com bubble here, but at the moment I've got the money multiplier, which is the M2 money supply divided by the St. Louis adjusted monetary base, compared to the inverse of gold. So gold is upside down. So if I get this backwards, I'll try to straighten it out. But remember, gold is upside down. Now look what happened going into the mortgage bubble. Gold was rallying. Again, it's inverted, so it's falling. So everyone, buy gold, buy gold, buy gold, buy gold. You know, the Fed's cutting, it's got to buy gold, And then what? Hard reversal. In fact, it reversed all the way back to pretty much where its breakout point was. Now, isn't that interesting? Did a hard reversal all the way back there. What happened during the mortgage bubble is due to quantitative easing, which again, we've never seen before up until now. It happened in Japan, but obviously we're not working with data added from Japan. The money multiplier crashed due to quantitative easing. This is the closest form of money printing the Fed can actually do. This is to the extent of what their tools allow, and you can see that the money multiplier crashed because the St. Louis adjusted monetary base rose faster than the money supply, quite a bit faster, caused it to crash. As that happened, deflation hit the economy and gold sold off. Well, now it's rising here, but again, it's inverted, so gold sold off. As quantitative easing started to kick in and actually inject money into the economy, then gold goes on this multi-year rally from 2008 all the way to 2011. Huge monster rally. And the next time it's going to be even bigger. So what happens and what we should expect to see is when the money multiplier is rising, so let's zoom in a little bit, we should expect to see gold falling. And look what's happening right now. So what gold is trying to tell us is that the Fed's about to do quantitative easing in a massive way tomorrow. And even if they did start doing quantitative easing tomorrow, it still takes time for it to kick in. The answer is they're not. They might start talking about it, but they haven't turned on the spigot. And even if, look, it's like driving your car, right? You know, you're doing 60 miles down the highway and you need to turn around and go the other way. Well, you have to slow down, turn around, and then reaccelerate. The Fed can't just be like, turn, go. It does not work that way. Same with this. So what we should be experiencing here is gold should be falling, or it should never have had this little rally here. Hence why you get this big part of this reason you get this sell-off, and then you get the big move. So that's one reason. So from that standpoint, we know that this should not be the big gold rally, because the big gold rally comes during massive easing. The second way we know that is due to how hedge funds are positioned. Now, there's a reason I show you this, and I want to come back here. We looked at this Monday, but this is how hedge funds are positioned as of last week. They are very, very long gold, and probably even longer now, I would guess. But for every long position, there has to be an equal number of short positions. So what happens is when you have a lot of longs, and someone up here, let's say that you bought in here, right? And your target was, return was somewhere up in here, and price gets up, and you go, well, I'm going to start selling. Well, when you have a lot of shorts, again, that are showing opposite here, on top of a lot of selling, you get violent price moves to the downside. Hence why when you get these big shoots up, you get big shoots down. So we know that the hedge funds are very, very long gold, and they're probably going to sell at some point. Now, why are they going to sell? Well, that's what makes it even more interesting. You have to understand, investing just isn't about like, well, look, a stock, I'll just click and buy it. You have to think, how is everybody playing? This is a big game. In a sense, the stock market is a lot like going to Vegas, except you're playing poker. You're playing against the other players with the cards that are being dealt. This isn't like a slot machine or blackjack. You're playing against other players. Now, what do we know? We know the hedge fund managers, or the dumb money, chases anything that's moving real quick. We know the smart money wants to load up on gold because they believe during the next recession, as I do, that when the money multiplier hits 1, the Fed will just keep printing and nothing will happen. But they're going to just flood things with as much quantitative easing they can do. And that should be really bullish for gold. So what in the end result is, the smart money is short because they need all the dumb money to sell out so they can accumulate it and then go. Get it? All right, now let's go back over to the PowerPoints. Oops, because I've kind of put down how this should look. This is the way you should be looking at it. So hedge fund manager positioning and why gold falls when volatility spikes. Now, you're not going to see this chart anywhere else because I made it up. But it's based on all the data we get from hedgeopia.com. So how are hedge funds positioned? Well, large caps, they're long. If the market crashes, they take a loss. What will they have to do? They will have to short the market to cover their longs because they won't be able to sell. In small caps, we know they're short. If the market crashes, they're in a gain position. They will hold these, although I didn't have enough room to put, but they may be forced to sell them to cash in on the gains. How are they in U.S. Treasury bonds? They're short. If the market crashes, they take a loss. They've been taking a loss. What do they have to do? They have to buy Treasury bonds to cover their short positions. Crude oil, they're long. Crude oil has been going down too. If the market crashes, they take a loss. They'll have to short to cover their longs. So far, you see, I'm going to need money, right? We'll come back to gold. Volatility, they are short. If market crashes, they take a loss. They'll have to buy volatility. They'll need money. The US dollar, they're long, but currencies can move in bizarre ways for bizarre reasons. So we'll just say we don't know exactly what dollar's going to do if the market crashes, and nor do we know how they're going to have to protect their positions. Now let's come back to gold. They are long. They have a gain position. If the market crashes, we know gold's going to fall, but part of the reason gold falls is, what do these people have to sell to cover all of their other positions? You sell the thing you made money on. So you sell gold to cover your vol shorts and your treasury bond shorts, and maybe to buy some shorts on stocks so you can keep from losing your money, and some shorts on gold or oil so you keep from losing your money there, or reduce your risk. That's why gold sells, because it's liquid. Everybody wants it. There's a lot of demand for it, and they're in a gain. So that's why. It's pretty simple. All right, let's hit some charts, and then we'll chat about what we're going to look at position-wise. So the S&P 500, not really now any further than it was in January 18. So anyone who bought there is really not making any money. Let's look at the Treasury bond market. This is where all the action is happening. Here's 10-year Treasuries, which everybody told me were going to the moon, and I said, nope, topping pattern. Now look, they're almost at their all-time lows. They got down to 1.6%. The lows were at 1.3. That's not very far to go. And then they found, due to a poorly received auction, which I'm not surprised about, yields rose today. Look at 30-year yields. They pretty much got to their lows. A lot of people said I was wrong. It's very hard to argue. This is what the truth is. Now we're going to come back to this. Let's take a look at gold mining stocks. They came up to resistance here. It got rejected. Again, they've never confirmed their moving averages, but look at silver miners. They hit resistance twice. Enough times you knock on the door at resistance and don't break through, you sell down. This is a beautiful pattern. Sentiment level is high, so it's telling us that maybe this thing is overcooked, but gold just got way out of line, and that's why it's probably going to reverse. So let's talk about bonds, because I think that's where I'm very, very interested in. Let's talk about making easy money in bonds when the Fed eases. So as I mentioned before, when the Fed lowers interest rates, and I've shown you the charts, and if you missed them, go back somewhere in the last week, and you'll see where I did the presentation on federal funds rate and its correlation with short and long-term yields. When the Fed lowers rates, and now that, what did I see, like 18 foreign central banks have now lowered rates, the Fed will have to keep lowering. They will. It's just a matter of fact. As they lower, all yields fall. That's how the system works, okay? So it's not a surprise that Treasury bonds are breaking out. Plus, the Fed did also say, and now you'll remember some of the stuff that said back when everyone was, thinking I was nuts and on the wrong side of the market. You now see we're on the right side of the market. The Fed said we are going to stop our balance sheet unwind, which they stopped early, but we're going to replace our long-term Treasury bonds with short-term. And I said when they do that, it causes long-term interest rates to fall. Well, that's exactly what happened. Boom, long-term interest rates fell. So we got up back to almost to their all-time highs today, a massive area of resistance. So people that are shorting Treasury bonds would think this is a great place to short because I made money here. I'm going to do it again. No surprise. That's what I would expect to happen. Now, these Treasury bonds should come. I assume there's going to be some selling down to about this 138 level. There's now going to be quite a bit of resistance going back to the early September 15 highs, and of course this cluster in 2016. I'm expecting it to drop down into here. Now what I'm interested in is simple. Why would I want to go chase something that I know might actually fall? Now gold may continue to rally. But again, you want to take the easiest route to make money whenever possible. So how do you do that? Well, in our legacy portfolios, we have 10% in ag commodities. Most we have a position in long-term Treasury bonds here, which looks looking really good since we switched all over to that. We have the cash position, which recently I put into short-term Treasury bonds. But what I want to do, and maybe in the days or within the weeks that follow, probably not even weeks, maybe too far, is I want to take those short-term bonds and put them into zero coupon Treasuries, 25-year plus Treasuries, which look like this chart. And you're going to say, well, that looks just like the other one of long-term Treasury bonds, because effectively it is. These are just the highest risk version of them. And what you should be thinking right now, so wait a minute, Steve, if the Fed's lowering interest rates, that drops the risk level way down. Bingo, you've got it. You got to think like the smart money. What is the Fed likely to do? Lower interest rates. What happens when they lower? Yields across the board fall. How do I make the most money during that period without taking a whole lot of risk? Long-term Treasury bonds. So these, in my opinion, are more of a proxy against equities than they are bonds. Even though people will tell you stocks have been the biggest winner, if you go back over the last 20 years, treasury bonds have outperformed the stock market by a lot, way more than you would think, by like 30% more. Seriously, if you would have bought bonds back in, say, 82 and sat on them, you'd be way ahead of the stock market. Like the difference between a 300% return for bonds and a 200% return for stocks, seriously. So why would I want to buy this stuff here as an equity style allocation? Simple. There's something called duration. And the way duration works is for when interest rates fall, say 1%, bonds rise in equivalent. Well, the duration on this is 27. So for every 1% fall in yield, this fund goes up 27%. Well, where are yields going to drop? Well, let's go and look real quick. 30-year yields are sitting here. They tend to drop if we zoom out far enough. They tend during recessions. Here's 2008. They were at 4.1 to 2.6. So you're talking, let's see. What did I say? 2.6. So you're talking they drop 1.5%. Well, multiply that by 27. It's a 40% return. You get it? So why would I want to chase gold right now, knowing that all I need treasury yield to do is pull back a little bit, right? So let's go back to those bonds. Let's go back to the TLT here, right? All I need is this thing to come back down, maybe come back down here and fill the gap, possibly come way down here, hit the 50-day moving average, I don't know, but come back down some, because we know the banks are buying, we know the Fed's going to be buying, and load up on load the equity position on zero coupon 30 years, and get an equity style return with minimal risk, and do it in a real quick period of time. You say, wait, what do you mean quick period of time? Well, when volatility happens, let's go back to 2008. Where's 2008? When volatility spiked and interest rates plummeted, so where are we at here? We're at 11/18/08. So 1 month later, big spike in return. Volatility is going to blow this market out within the next 90 days, mainly due to foreign central banks easing, forcing the Fed to ease, and due to the fact that U.S. Treasury is going to borrow an additional $350 billion in the next 3 months. Volatility is going to spike, interest rates are going to crash, and bonds are going to make a lot of money. When this is all said and done, the Fed's going to ease in a big way because they're going to have to. And then you sell all that stuff and then buy into gold miners, which price should have come down. Get it? Got it? I'm Steve Van Metre. Thanks for watching. I'll see you Friday for a deeper, longer weekly economic update.